Hi everyone, I'm Eugene and this is Finance Talk. Today we will speak about one of the most crucial mistakes which modern investors make. And I'm not talking about not having investment checklist or differently calculating PE ratio, which I spoke about in my previous videos, but more simplest one. This mistake can cost you thousands of dollars, sleepless nights, and maybe mental health. And this mistake is buying companies only based on their dividends, which is also known as dividend trap. If you want to understand how to avoid these traps in your current or future investments, stay tuned. But before we start, I strongly recommend you to subscribe to this channel and hit the like button for great confetti, because as a community, we will grow faster in our skills and knowledge in investing field and become better investors at all. And now let's start. First of all, let's understand what is actually a dividend trap. I will give you a simple example so you can understand the logic. Suppose you have $100,000 and you would like to invest them in the stock market. You heard some news that a great way to invest is to buy dividend stocks, which has high dividend yields and can give you a huge passive income. So you do not need to do anything but receive your paycheck every month. You go to Google or any other web search and type the highest paid dividend stocks in this year. And there are a lot of results in the search. You go on every one of them and read articles carefully and understand that there are 10 companies which pay highest dividends in this year. And you go to the Robinhood or any other app and buy all of them. Suppose you invest $5,000 in 20 stocks, which pay highest dividends in this year. In the beginning, the strategy works great. You receive your dividends every month or even every quarter, and they're quite stable, and they actually are increasing. And you're beginning to realize that the life is a great thing. You find the gold mine, and you're looking for more money to invest, thinking where to spend your next vacation sipping the cocktail. And then this happens. You receive the news from the management that they want to improve the balance sheet and they will cut dividends in half. So now you not only have your dividends which are cut in half, but also the stock price has dropped because most of investors like you who wanted high dividends just sold their positions. So the stock started to trade twice lower than it was initially. So instead of $100,000, now you have only $50,000 net worth. And in this case, you make the decision to sell some of your positions or all of them, declare the loss, and you say that your life has ended, the market doesn't work, and now you have a depression. And this is the classical example of getting into dividend trap. This is the situation when the management of the company attracts as much investors as they possibly can, offering higher dividends than average on the market. And after that, they stop paying them. Now, let's understand why this situation actually happens and what is the true cause of this. Here I have a company X, which increases its revenues on 20% every year for the last 3 years. As we can see that the company in the first year earns $1 million, its expenses $700,000, and net income is $300,000. Now, the CEO of the company has the full right of distributing net income of the company according to the company's strategy. The management can spend this money on several things. First of all, it can reinvest some portion or all of it. For example, our company has 100 locations across the United States, and the money needed to open 101st location in order to increase the sales of the company. The second way of distributing net income money is to repay the debt. If the company is huge, it probably has some long-term or short-term debt, and this is crucial for the company to pay off its debt as fast as it possibly can, because it not only increases the margins of the company, but also it will help you as an investor to earn more money on your stocks. Third way is to buy back shares. If the company distributed some money into growth and debt repayment, it can also buy back its shares. You as an investor receive more money from the dividends or from the increasing of the price of its stock. And the last way, if the CEO of the company doesn't have any alternatives, is to pay out dividends. This money which is taken into dividends is split between all shareholders, common and preferred. And here where you as an investor receives your paycheck every month or every quarter. Now, this is very important. The CEO of the company has a legal right not to pay you dividends at all. and reinvest them or buy back shares or repay some debt. So if you see that the company has speed growth or it has some problems with the debt, you can probably project that these dividends will not last forever. Also, you need to look into cash flow statement and calculate free cash flow of the company. If you do not know how to calculate free cash flow properly, or you do not know how it is used, I have another video right here which you can watch in order to understand the concept. This indicator shows how much money does the company have in order to pay out its obligations, its dividends, etc. If the company doesn't have enough money as a free cash flow and it declared some dividends to be paid, it has to borrow money from somewhere or issue more stocks, and you as an investor can be damaged in this case. You can partially or entirely lose your money. Now let's talk about how you can avoid these dividend traps in your future or current investment. First of all, you need to look at free cash flow for the past 3 to 5 years. Understand, is it actually improving? Does the company have enough money to cover any losses, any dividends, which the management claims to pay to its shareholders? Then you need to look at the sales for the past 3 to 5 years in order to understand the dynamics. The main idea here is to clearly understand and see that the company improving its performance, the revenue increases, and it actually has enough money to expand its business. Then you need to understand how many stocks actually outstanding on the market, and is this number actually increasing or decreasing? Because if the company issues more stocks for their investors, it is the red flag for you that the company doesn't have enough money, or it grows so fast that it needs additional money from the shareholders to cover its losses or open new locations or facilities. Is the company increasing earnings per share every year? This indicator is connected to revenue growth, and this indicator is quite useful for you to understand the financial position of the company. If you do not know what the earnings per share actually is, I have another video on my channel which actually explains this concept. You can see it right now. You need to understand why the company has high dividend yield for the long period of time and why this is bigger than its competitors or industry average. In this case, you need to dig deep in order to understand the true course of that. Maybe the company has some debt problems. Maybe there are some lawsuits which occurred previous years, or maybe there is other problem. You need to understand the true problem of that, and you need to understand that this level of dividends will stay the same for a long period of time or will actually increase. Now, let's speak about my opinion on this topic. Personally, I do not buy stocks based only their dividends. I'm more value investor in this case and analyze different indicators and the whole company information about the industry, about the competitors, about the competitive mode, etc. So I have clear understanding that this company is undervaluated, it has a lot of assets, and its sales will increase in the nearest future. If it has dividends, it is okay, but it is not the first factor for me. That's all for today. I hope you enjoyed the video and it was useful for you. Also, please subscribe to the channel for more great videos and join our community of people who are interested in finance, investing, and business. Thank you for watching. Bye.